too broad of a brush, but I think it's safe to say liquid alts have gotten some ire lately, and especially when you compare them to something like the S&P 500 that's done so well, obviously maybe not done as well as a lot of advisors would like. I think there's a sweet spot, and I get questions all the time from advisors saying, you know, we have bonds here with low interest rates, we have stocks here with high valuations. What can we do to bridge that gap and do something in the middle? And obviously liquid alts is a place a lot of people have turned in recent years. And I just want to, so I've been actually working my way through, I'm the last person on earth to see The Sopranos. So I've been watching him talk with Dr. Melfi and unload a little bit. So I want to give you guys all a chance to just, I know I'm overgeneralizing here because we're all in different areas, but other than it's been a 10-year bull market and the Fed manipulates everything, what are some actual really good reasons that we've seen this underperformance? What are some good sort of, maybe not excuses, but reasons that we can point to say, you know, this is actually kind of normal? So whoever has.
Well, you know, one of the things that springs to mind immediately is you got to go back, you know, 10 years before the financial crisis, and you know, people, you know, bought into the idea of liquid alts for diversification purposes because of the lack of correlation to the broad market. And you know, frankly speaking, what happened is that didn't work during the financial crisis and after, and correlations were a lot higher than people thought. And I think people bought into, you know, strategies such as market neutral, thinking that, you know, there would be a very low correlation to the market, and actually a lot of the market neutral strategies actually had a high correlation. So I think that's kind of where it started, and then, you know, it only got worse with the bull market thereafter.
I think that one of the fundamental misunderstandings that people have is that liquid alts and having to conform to the 40 Act takes away part of the alpha that you get through traditional alternatives in hedge funds, which is the illiquidity alpha. And when you take away that opportunity for illiquidity, which is where a lot of hedge funds are able to outperform, right? Because they can invest in stuff that a traditional public investor cannot. And they can do that because they don't need to have daily liquidity. And when you can't do that and you have to have daily liquidity, then you, by definition, have to invest in the public markets, and you're going to have higher correlations than traditional hedge funds and other private vehicles. And so when we think about liquid alternatives, I think we need to think about them for the diversification benefits that they can provide, so that you can get alpha from your traditional sources. And when you think about it that way, even with their underperformance, they still make a lot of sense.
Any from our two people who are more into the liquid side of things, from your perspective, any sort of anything that flows together with those, because hedge funds have obviously not done very well either. What are some of the similarities there between what's happened on the liquid and the illiquid side?
Well, I may just add to this concept. So, you know, I think it's not so much just that the market's gone up. That makes alternatives hard relative to traditional asset classes, but it's also what the markets have done, which have made it difficult within the alternatives asset class. So you've got markets that have been driven by concentration. So narrow segments of sectors, stocks, regions that have definitively outperformed. That's made it hard for one of the main purposes of alternatives, which is diversification. So diversification has not been your friend for the last 10 years. That also, I think, hurts when you think of the fact that prices have moved beyond fundamentals. So any strategy that's got a value orientation has had a lot of tailwinds to be up against. And then lastly, if I think of one category of product that I personally really like, the managed futures category, in whipsawing markets like we've seen, and in compressed spreads, it's been very hard to take advantage of some of those dynamics. So I think not just that the markets have gone up, it's the way in which they've gone up, which has presented some challenge for the alternatives asset class.
Yeah, and to add to that, AQR has been critical. It might be like a self-loathing thing. We've been critical of the alts industry, even though we're one of the biggest alternatives investors, for about 2 decades now, and for one reason. We find, by and large, most alts, and this could be on the hedge fund side or the liquid alt side, they're pretty good at delivering you non-alternative returns. They're pretty good at giving you equity returns and bond returns. And so curiously, you know, in the past 10 years, the alts, I heard a lot of F words in the last panel, so I'll use some S words. The alts that have sucked the least have done the suckiest job at being alternative. They're the ones that have given you some of that beta return, some of that either from stocks or from bonds. And like you were saying, you know, when it comes to reasons for underperformance, there are some good ones. So you mentioned the value premium. Value had, I'm going to use the S word again, value has sucked over the past 10 years. There's no way around it. So why has your alts manager been underperforming? Well, it could be attributed to that. If that's part of their value proposition, no pun intended, that could be as good a reason as you're going to find for underperformance. Trend following, managed futures is another. We have found the past 10 years have been atypically lacking in trends. We've looked at trend following over 100 years, and we found this has been sort of a shockingly benign environment, just the type where you would expect trend following to do poorly. Now, the good news is, of course, if you expect markets not to be atypically calm for going forward, and we don't, then you would expect these strategies to go back to their historical averages, i.e. good returns.
I mean, I think you guys really missed out on the hard seltzer trend, actually. That was a big one. Never mind. Okay, so if you're a financial advisor and you're hearing this stuff about the underperformance, what are some red flags to look for in terms of what are some of the poor excuses that you don't have to name any names here, obviously, but some of the stuff that people have put out there that really is just showing that you're probably invested in the wrong strategy or manager or whatever?
Yeah, maybe I'll start because I went last time. The one that I think is the dumbest is, oh, they were supposed to suck when equities and bonds do well. I don't know who would ever sign up for that ride because you expect equities to have a positive expected return. You expect bonds to have a positive expected return. The problem with that thinking of, oh yeah, you should have expected alts to do poorly is that's hedge thinking. That's not alternative thinking, okay? Hedge or insurance is you pay some price to avoid bad times, okay? So in a bull market, you would expect a hedge to do poorly. Alternatives, you wouldn't expect it. And so don't take as an explanation, this is what was expected from alts. This is not what's expected from alts. The past 10 years have been not atrocious with a capital A, but maybe with a lowercase a, atrociously bad for alts by and large.
And so thinking about that, taking it a step back, like, what's the actual allocation that advisors need? And do they need something between equities and fixed income?
I actually think they do, and I've done some work on this, and 20% tends to be the number. But I think the focus needs to be on the diversification benefits of what you're adding to the portfolio. So I spent a lot of time when I joined CLS working on our alternative model and focusing on, it had done really well, but it had done really well because it had a really high correlation to equity markets. So we kind of touched on that. You know, you're thinking you have alternatives, but you don't. You have equity beta. So the first thing I did was look for things that had low to no correlation with equities and fixed income and added them to the portfolio. And that helped a ton. We still get good performance, but we got some diversification benefits. And I don't know if people spend enough time looking for the alternative options that have low correlations and focusing on that and not necessarily focusing on a specific performance track record.
I may just add, at JP Morgan, we have a portfolio insights program where we analyze a number of advisor portfolios. I think we've done something like 15,000 year to date. For the advisors that have alternatives, and not all of them do, actually the minority do, what we do see is that a lot of people have something like 2.5% in alternatives. And that's the problem, because I think that's the worst of both worlds, right? You've got the messaging challenge, which we know is real, right? The fact that you have to educate your end clients about what these products are supposed to do in the portfolio, and then constantly have to be re-underwriting them. But you don't have enough to actually help you in the way it's supposed to. And one of the analyses we did is we looked at Q4 of 2018 to think about what is the amount you need to really move the needle. We would agree it's something like 20%, but the place I would absolutely avoid is the really small amount where you're kind of suffering on the messaging side but not getting the benefit on the product side. Mm-hmm.
Yeah, I was just going to say that I think, you know, the simple answer, I mean, we approach this from a perspective of, you know, gold being the original liquid alt. And when you think about the 60-40 portfolio or fixed income and equities, you know, this is a question that, you know, people have been trying to answer in terms of Markovics Theory for 60 years. And the simple answer is that, you know, you do need something else in the portfolio. I mean, we just did a big piece of research looking at the 60-40 portfolio over the last 15 years. And in every instance, you know, whether it was 1% up to even 40% in terms of replacing that fixed income allocation with gold, in all instances that improved the efficient frontier. And actually the optimal allocation, believe it or not, was 35% gold. So 35% gold, 5% fixed income, and the rest in equities. And even it was actually a piece that we've got a booth for anybody interested in. But even shorting fixed income and using that to further increase your allocation to gold past 40% still increased your Sharpe ratio, which was kind of a fascinating thing. So you could entirely replace fixed income.
You are the bravest man on this stage.
Yeah.
Maybe this will make it kind of more fun for the audience. I would never short something that has a positive long-term expected return, because then you have this funding risk, right? And returns are so noisy. It could be tough. I applaud your heroism, but I am cowardly on this side.
I'm not saying people are short. I'm just saying that
yeah.
that would just the data or the facts behind it, like the science behind it, is irrefutable.
Yeah.
So
I agree that where you take your portion of the portfolio and allocate to alts does come generally from fixed income, because that's where you get the most bang from your buck in terms of diversification. But I don't know if I necessarily agree with taking that much out of fixed income, because most clients do need the yield, which you couldn't get from something like gold, or most alts don't have the yield opportunity that fixed income does, that they need for their portfolio as well.
I think the 60-40 also, it's not that the 60-40 is broken, it's in uncharted territory. So what I would be thinking about if I was an investor is the fact that you're making one massive bet when all you're doing is 60-40. You're making a bet that the correlation between equities and fixed income for the next 10 years will look like what it's been for the last 30 years. And so that, to me, is alone one of the most compelling cases to think about having some alternatives in your portfolio. Do you want that kind of pin risk in your portfolio if you're trying to solve for all different macro environments?
So I will kind of let the Fed take some blame for maybe the underperformance, but maybe a lot of people don't understand, many of these strategies are essentially cash plus strategies. Mm-hmm. And so lower interest rates have effectively removed some of that return that you got in the past. Now that's true for everyone, obviously, but is that a potential headwind if interest rates stay low for the next 2 decades, let's say? Maybe a possibility. Does that then bring your hurdle rate down and your expected returns for most of the space in many of these strategies?
See, I refuse to look at this space as just alts. Sorry. I'm totally that person who will interrupt you. It's the whole Boston in me. No, but I think it can't look at alts in a vacuum that way.
I know, is that a worry going forward for anyone? That those, obviously maybe that's a worry for everyone, but that really impacts the space in a big way going forward.
Yeah. Sorry. Do you want to go?
I just want to make it clear.
And we totally kept interrupting you.
I don't want to.
In rehearsal, we weren't doing this.
Yeah.
We're going to play bore on the floor here, if anyone lets Succession. See, I will say Yasmin and Will have both appeared on my podcast, so I will defer to them in any arguments, but no, go ahead.
I think it has to. This is what's happening around the world. You've got 18 trillion worth of government bonds now an issue with interest rates below gold, i.e. negative interest rates. You have Denmark issuing the first mortgage with negative interest rates, so paying people to take out debt. The Bundesbank has just green-lighted this as well in Germany. This is Germany we're talking about, a country that went through hyperinflation, that knows the value of money probably more than most countries on earth. So this is kind of an extraordinary situation. So going forward, return expectations for assets such as gold, almost by definition have to be higher in a world where countries are competitively devaluing their currencies and bringing interest rates down to low, if not negative levels. That's just the science behind it.
Yeah, and low cash rates affect everyone. I think one of the unique challenges today is that it's not just low rates on cash, but it's also extremely expensive stock and bond markets. Historically, when stock markets have been expensive, bond markets have been relatively cheap, and vice versa. This is, to take kind of the uncharted territory term, this is sort of unique in that both stocks and bonds are expensive versus their histories. Now, yes, alternative returns, liquid alts, their expected returns should be lower along with the cash rate. You can think of the cash rate as sort of the base for everything. One of the benefits of liquid alts is if you are long and short, you've hedged out that kind of valuation risk. You've hedged out, because you're not long stocks, you're not long bonds, you've hedged out that component, making traditional asset classes unattractive. And so on a risk adjusted, kind of for the nerds out here, on a Sharpe ratio basis, liquid alts, in theory, and we've looked at this empirically, shouldn't have any worse risk-adjusted returns over cash than they have historically. But on a total return basis, liquid alts, along with everything else, should be kind of lower expected return. The benefit, the silver lining, is that they don't get hit by the double whammy of also being long, expensive stock and bond markets.
One of the challenges, though, that I do think exists is that argument for higher interest rates was one of the arguments that people used for the impetus for some of these challenges to go away, right? So if we think about the value factor and how long that's underperformed, and we would tell you it's something like almost 3 standard deviations cheap, and it's moving very similar to interest rates, most people would argue that this environment has allowed those growthy, maybe junky stocks to continue to live on because they're not struggling with the reality of having to roll their debt. But if we see more of that, like, it can continue for much longer. So I think we do have to prepare ourselves for the fact that maybe some of the catalysts have a lot longer of a runway in terms of reversion to the mean.
So that gets into this idea of kind of client education of people that actually own these funds. And I think one of the hardest parts is you almost have this paradox of choice. It's a double-edged sword of, it's amazing that individual investors and financial advisor clients now have access to these strategies that were once really expensive and illiquid and not very tax efficient. But on the other hand, liquid alts as a group contains a wide range of products. You talked about from hedging and bear market strategies to trend following to everything in between, long short funds. So how do you get people comfortable picking those funds? How do you help advisors to search through all these thousands of funds and figure out the right choices for their portfolio? Is it one fund? Is it 5? We talk about the allocation, but how do you drill down into those individual strategies?
Well, I try, at least in what we're doing, like I touched upon before, is to start with the correlations and look for the funds that have the lowest correlations to my equity and fixed income or what else is in my portfolio. And I kind of narrow down that list, and you don't end up with a lot, but then when I have narrowed down that list, I can look to diversify amongst those into the different types of strategies. So, for example, one of my favorite funds, and I go on TV and I tout it all the time, and they don't pay me or anything. It just really worked. There's a fund out there by AGFIQ called Market Neutral Anti-Beta. So low vols really worked, and I think low vol will continue to work. That fund is low vol on steroids, and it has low correlations with equities, and it's done really well for our portfolio. So it's doing exactly what I want alt funds to do. Those things exist. So when you look at the framework of like the environment we're in and what's out there, you start, in my opinion, with the diversification benefits, not the return benefits. You're looking for the correlations, and then you look at the list that's left and work from there to provide diversification within the alts that are left. And you'll end up with things like put option strategies, you'll end up with bear market, all sorts of different types of strategies, and you can diversify across that and get the diversification in your alts as well as to your traditional portfolio.
Yeah, and I'm sure you agree with this. So correlation is low correlation. Diversification, identifying what kind of isn't already in your portfolio, that is necessary, but that is not sufficient, okay? Because obviously you also need returns because you have clients that you're speaking with. There are a lot of strategies, a lot of kind of insurance-oriented or long put option types of strategies. They're going to look great from a diversification standpoint. Mm-hmm. They are going to look god-awful from a return standpoint, both realized and expected returns. And so what I would kind of add is, yes, for sure, look at correlations. Figure out what's missing from your portfolio today. That should be the arena in which you hunt for new liquid alts. The second thing you want to do is identify, okay, well, what are the return sources that I'm missing? Which of the alts that survive that first screen give me the greatest bang for buck, right? So maybe you're missing the value premium. We talked about the value premium. Maybe you're missing some of the value premium. Maybe you're missing some of the momentum premium. Figure out, okay, here's all the managers that might offer that. Which one gives me the greatest exposure to that relative to the fees I'm paying? And that can be a way of substantially reducing the number of managers that you have to kind of to research on. Those are very great initial screens to take.
I think maybe one thing to add on this is sort of what's the role in a portfolio and your portfolio? So being very customized about what you're trying to achieve. We sort of have a framework of equity alternative, fixed income alternative, and core diversifier. And the metrics I would look at across those three categories would vary when I think about beta, volatility, and correlation. So being really, really clear about what it is you're actually trying to achieve. And I'd be very careful of looking at the categories. To your point, the ranges of betas that you can see in something like the multi-alternative category, the variety of strategies from diversified to niche can be very, very wide. And so manager dispersion is unfortunately large. And so just being category focused is a big red flag, I think, in this space.
Okay, I'm going to go to a question here. This is a pretty good one. How do we reconcile the dichotomy of simple investing just by cheap beta and hold and getting into more complex alts? And I think that, again, comes down to the education thing, but how do we, there's been this huge push into simple investing lately, obviously in low cost. How do we marry those two?
Well, I mean, I think I'm not necessarily sure that you have to marry the two. There's been a push into simple, low-cost investing because it works for the vast majority of people and clients understand it. And investing doesn't need to be complicated. What we spend a lot of our time doing is working with advisors on the portfolio construction process. So that's about looking at advisors' portfolio and just saying, okay, with one or two very simple moves, I can lower the cost of your portfolio and give you a higher return for the level of per unit risk you're taking. And a lot of people, I think, are trying to kind of overcomplicate this. It doesn't need to be. And what is really, I think, winning for people at the moment in this ultra low interest rate environment is low fees and keeping something simple, which you can explain to clients.
But how do we set expectations? Is it an expected return framework? Is it helping clients understand the range of potential outcomes in these strategies? What is the best way that you have all found in terms of educating clients and helping them understand what they're going to get out of these things? Because I think that's a big problem, is that we have this huge gap between expectations and reality for these.
I think it's about looking at it holistically, right? Like, I think we spend so much time, because we think they're complicated, trying to over-explain, right? So I start with the whole portfolio and how this particular component of the portfolio helps you on a risk-adjusted basis, and then show it. If you're doing it correctly and you're following the right steps on how alts should be used, you can do it holistically. You don't have to overcomplicate it. I think much of the reason we consider it complicated is because we feel like we have to over-explain what they are, and I think that's part of the problem.
Yeah, maybe to whoever a basic mind is, congrats. Surprisingly, I can't agree more. Whatever you do, whatever active choice you make in your portfolio, there will be a period in which you underperform. Okay, that's guaranteed, unless you happen to invest in Madoff, in which case you get a few years of not underperforming. So what you have to ask yourself is, okay, I know I'm going to underperform at some point. What's the easiest thing? What's the easiest reason for why I've underperformed? If alts are too convoluted for your end investor, don't invest in them, okay? We have this saying at AQR, a good portfolio you can stick with is better than a great portfolio you have to sell at a bad time. And I think that works great when it comes to the decision of whether or not to allocate to alts. Okay, so that's why I wouldn't allocate to alts. If you can't defend their existence when they're underperforming 60-40 or whatever you think of as a benchmark for alts, don't even bother. Okay, but why bother? Well, there's a couple reasons. Take a 60-40 portfolio. It seems diversified. It seems like it's got stocks and bonds. What's the correlation? This sounds like the start of a joke. What's the correlation between a 60-40 portfolio and 100% equities? 0.99. And that's not unique over the past, that's over 100 years, okay? So when it comes to what is going to kill me in my portfolio, stocks, anything, and it doesn't have to be liquid alts, it could be anything that has a positive expected return and isn't loading up on equity risk is probably going to be valuable to your clients. The hook, though, the catch, is harder to explain. And so that's really the trade-off, I think, when it comes to whether or not kind of the to be or not to be alternative for most investors. It's really, can they stomach the underperformance where you don't have a great reason for it?
I couldn't agree more, and I would also just add not to shortchange the explanation, because where I think this gets a little dangerous, is confusing, and you hit on it, hedge versus diversification. And I think one of the hardest parts with alternatives is people so badly want to describe all of them as a hedge. They want to so badly describe that when the market's down X, you're down Y, and there's a predictability to it. That's very, very different, obviously, than injecting uncorrelated return sources into your portfolio. So if you can't stomach that distinction and you can't own that message, then to your point, I absolutely wouldn't, because the worst outcome is you misdescribe it. You have a short, where I hit the phone calls I hate is when there's a short period of equity market volatility. I'm talking like a week, and people really want to see this mathematical formula and performance. So if that's where you have to go, I would absolutely stay away. But with that said, I do definitely agree there's all the benefits that you, if you can handle it, that are really worth it.
So yeah, let's say someone decides they don't think they're nebulous and they want to try this space and they're worried about bonds. So the next question, how would a total noob whale go about educating themselves in liquid alt space?
Is noob whale supposed to be capitalized? Is that like an official term?
I found out the other day, that's actually a term for a podcast. My phone autocorrects to that now, which I think is one of the better parts of the technology world these days. But so, yeah, and Dan, I know you have a podcast that kind of covers some of these strategies. What are some other ways that, some resources people can go by that they determine, they want to find something in the middle of stocks and bonds. How do they educate themselves? Because there is a lot of information out there these days.
Yeah, I'm sure every one of us will refer everyone to our websites, so let me just get that out of the way. We get this question all the time at AQR. So on our website, we have something called a learning center. And what we have there is we just consolidate all of our kind of introduction to liquid alts. So that would be kind of my one-hit kind of recommendation for learning. Our podcast has a couple episodes too, but the learning center is probably the most efficient.
I mean, one of the great things for investors right now is that asset managers are pouring a lot of resources into free tools for you to better understand the space. So we have on our website a digital portfolio, a digital portfolio insights tool where you can load up your portfolio and do all sorts of scenario analyses on it. It's free, and you don't have to talk to anybody, and I think that's a really potentially powerful way to customize it towards your own needs. I'll also say there's a need for a lot of product agnostic education in this space. One of the biggest challenges I imagine is sitting in an investor seat is that everyone's coming to you with their angle. So we've launched something called the Guide to Alternatives, which is not attached to any product team. It's anyone familiar with the Guide to the Markets will know that it's just sheer data, completely product agnostic and data driven. There needs to be more of that, and I would lean upon product agnostic resources like that.
I wrote a white paper in 2008 that is super dated, but it was written for that specific reason, to have sort of a product agnostic, total educational, totally targeted at a retail client. That even today, if you can find it, come talk to me after, I'll give you a link. It is out there. I know a lot of advisors have found it helpful because it's a really simplified way to look at the benefit of investing in alternatives.
Any worry about the increased competition in this space? And so, Will, that could be in commodities, it could be in liquid alts. So obviously, not only have we seen a lot of liquid alt funds come to market, but hedge funds have gone from a couple thousand in the 90s to 10 or 11,000 now. Is there worry about capacity in this space, or is that something that we shouldn't be concerned about for a long time?
I think it's, again, depending on the strategy. So I'm sure these guys will test that on the hedge fund side, that's much more of an issue than the much more liquid side. I mean, obviously, in the gold or commodity world, there's no capacity issue. The huge markets that we're dealing with. But much more, I think, when it comes to the hedge fund world or on the private side, there are real capacity constraints. Again, it comes back to
has competition altered like the markets for like commodity futures, which back in the day almost seemed like free monies in the 70s and 80s. Now it's kind of flipped some of those relationships. Has the speculators jumping in done harm to those markets?
No, I think that what competition has done is given investors more choice, given investors better products at lower cost. And in terms of commodities and gold, you've never been able to invest in those at prices that, I mean, this is the lowest cost, best product set that's been available to investors ever. And that's happening not just in the alt side, that's happening in equity side and on the fixed income side. That competition, the big winner in the fee war is the investor. And the investor is the one that's taking home the benefit of competition within the asset management space, and ultimately the investor is the one that's winning through a better product at a lower price.
Yeah, I would say competition, if you ask, what do I think about competition, you give me no context, I would say I love it. But there are downsides to it. I don't think they outweigh the upsides. One of them is that you have just the proliferation. Liquid alt, a lot of managers say, oh, that sounds like something that I could charge a huge fee for. I want in. Now, one of the problems with that is now the choices you have, this relates to an earlier question, when it comes to liquid alts, you might have 100 different managers you're thinking of. The problem with having so many is that it really makes performance chasing awfully easy. Because now you can just sort, you've got 100 things to sort from. If you had 100 random variables, one of them is going to look like an all-star over the past 3 years. And so that's one of the problems with competition. Competition has been great in terms of reducing fees, increasing transparency, all of this. But it does put the onus, I think, on the investor to spend more time figuring out, okay, how am I not just falling for the manager that got lucky?
And along those lines, increased competition, especially in the liquid alt space, is great because that means fees become part of the conversation. And one of the downsides of liquid alts has always been that they've been really expensive. I don't think you will ever expect liquid alts to be able to compete on a fee level with a traditional long-only equity fund. The cost of actually doing and implementing the strategy is higher, right? It costs more money to short stocks. You have a margin account, you have to pay the interest on it. Same thing with futures. There's an implicit cost to just implementing the strategy that it will always be higher than just trading a single equity. So they'll always be more expensive, but increased competition is going to lead to opportunity to be able to gain access to alternatives at a lower cost than they've traditionally been available at.
And I think one thing we didn't hit on is the role of technology in this space, which is that we're becoming a lot more able to discern alpha and beta, which we've all gotten very comfortable with in traditional markets, and now are very clear about what we're willing to pay for alpha and for beta. That's ported over to alternatives, and I think that's a great thing for investors because you should be paying for what you're being delivered. There are systematic return sources associated with alternatives, and that should be delivered at a lower cost than true manager alpha. And before, that transparency didn't really exist in the market, and now with the innovation of more technology analysis tools that are being put on the desktop of advisors, it's becoming a little bit easier to make that distinction.
So this is a good question from Nicole in here. Saying that prior research shows that the best liquid alt managers have been hedge fund managers before. So this is maybe more of a qualitative thing if you're trying to screen these instead of a quantitative. Do you think it matters if you had prior experience in this space or if you're a manager coming into it late and sort of recreating these strategies? Do you think that matters or should that matter to advisors?
Depends on the strategy.
Yeah, I think it goes back to the earlier point. I can't remember who made it, but the whole sort of category in many ways, it's a liquid category that's spun out of the true hedge fund space. And so it's a 40 Act version of a traditional hedge fund. So by definition, you have hedge fund managers looking to get access to retail investors and therefore wrapping the strategy or some version of that strategy in liquid form. I think, the liquid alt sort of genre is just really another buzzword that we use to describe a whole raft of different strategies, just like we say smart beta and all these other things. And it just kind of depends on what you're looking to do. From an investment perspective, it defines the actual strategy that is best for you to implement for you and your clients.
Yeah. I think I know this specific paper that's being referenced. I updated it through maybe 3 years ago and found that the effect is still there. Managers who started as hedge funds and then went into liquid alts tended to do better on a risk-adjusted and beta-adjusted and all this adjusted basis than managers who started long-only traditional and then moved to liquid alts. I would expect that phenomenon will become weaker with time just because of free markets and competition. Smart people who work at hedge funds might see the opportunity in liquid alts and kind of move over there. So because human capital and intellectual capital is something that actually can move through time, I'd expect the phenomenon to exist. I'd expect it to persist, but to be mitigated going forward.
So this is a good one. Going forward, let's say beyond just a face-ripping bear market, what would be the scenario over the next 10 years where liquid alts actually come through for an investor and give better returns? What would that look like in an ideal world for everyone here?
I was hoping you would tell us.
I mean, again, it comes back to what are we talking about? If we're talking about gold, then I think I sort of outlined some of my thesis around why I think that's going to do well over the next 10 years. But that's very, very different to a market neutral strategy or any other type of non or low correlated strategies. I think it's dependent on what strategy you're talking about, and then what the future holds for that.
Maybe to give two specific strategies, because it's a very broad question. I think something like a managed future strategy would do quite well if we actually saw prolonged trends in the market, which we will, right? If we're thinking more like 3 to 6 month trends. And that's why so many people liked that type of strategy back in the financial crisis and why it did so well. So that would be one impetus where we actually start seeing true trend come in. The other, going back to the value premium, it's been so painful. I mean, one may say one of the best investments right now is long-short value. That I do believe that will revert to the mean, and so I think that's an environment where you'll see quite a significant uptick in performance, just given how much it's underperformed and being, again, 3 standard deviations cheap, what you'll see on the swing back from that.
I do think that strategies, market neutral strategies, if fundamentals start to really matter again, because they haven't really driven returns in the last 5 to 10 years. But if we start to see a market where fundamentals were truly driving excess returns, market neutral strategies would likely do very well because they are essentially just giving you the exposure to that pure fundamental factor.
Anyone have any thoughts on REITs? Is that being some sort of a liquid alt? I know that maybe that's kind of dipping your toe into the water for an advisor saying, we have an alternative strategy. Any research on that where someone could point to say this is actually a diversifying asset for people?
They tend to have high correlations with traditional equities. I mean, they trade in traditional equity markets. I personally have never considered REITs an alternative.
Yeah, I don't think it's an alternative in this context, but I do think, and we have a fund that has a REIT component to it. I think of it as an alternative source of income, meaning income that's not typically generated from bonds, or from dividend-paying stocks. So I do think it's an alternative form of income, but not maybe a classic liquid alt.
Okay, and then one more, I think, before we get out of here for lunch, a couple questions just on fees. Do we have a Vanguard effect of fees in liquid alts where they're going to continue to go down? And do you guys, I mean, it's hard to say again collectively, generalization. How do you think of fees in this space? Are they at a pretty good place? Do they need to come down a lot? Obviously, when you compare to hedge funds, they're probably a little better compared to straight beta. There's obviously a big difference. Is there still room for those to really come down?
Yeah, maybe I'll start. I think fees will come down. And I think they'll come down partly because of competition, but partly because the marketplace is going to wise up. They're going to wise up to the majority of liquid alts returns coming from just being long stocks and bonds. When you can get that for basically nothing from Vanguard, you're going to demand lower fees from your alts managers. Now, where I think fees might not come down quite as quickly is for alts managers that actually generate truly alternative returns. Those are a lot harder to get. They're a lot harder to get right. And so that might be actually worth the fee. If you're able to come up with a stream of returns that has nothing to do with the rest of your portfolio, that's actually quite valuable, and that's something where fees are sort of justifiably to be higher than traditional. But I think the march is steadily downward, and particularly for managers who've given a lot of passive equity exposure, their time is shorter than for others.
It's where capital's going as well as a function of why are fees in the broad equity and fixed income ETF market, why are those lower? Well, because that's where the capital's gone in the last 10 years and more. And it'd be the same in the alt space, that strategies such as gold, where there's been a ton of capital allocated by advisors, fees have come down rapidly, broader commodities, another space as well. And so if it's, CTAs or trend following or managed futures or whatever it may be, if that suddenly starts to win and there's a lot of capital allocated to that sector, you'll have more competition, and therefore, all things being equal, you'll see lower prices.
Good. I think that actually does it for our time here. So thanks everyone, and thanks everyone on the panel here for such a discussion.